Hi, this is David Thompson again with DocuTech, bringing you Episode 8 to our TRIDcast series. At DocuTech, we commit to being industry innovators in technology, compliance, and overall customer satisfaction. And with that drive, we wanted to know what would be helpful information for our clients with the new TILA-RESPA integrated disclosures. These TRIDcast episodes are a direct response from the feedback we received. In this episode, we will be discussing revising and correcting the closing disclosure. Today, we're privileged to have with us Fred Gooch, DocuTech's General Counsel and Vice President of Compliance, and Amanda McMurtry, one of DocuTech's Regulatory Compliance Specialists. Amanda is responsible for helping prepare DocuTech for the upcoming TRID changes and has over 5 years of experience in legal and compliance. Her knowledge has been extremely valuable for both our organization and our clients. A big thanks to both of you for being here today, and without taking up all the time, I'm going to hand it over to Fred.
Thanks, David. So during our last TRIDcast, we discussed delivering the closing disclosure, and the basic general rule being that you have to deliver the closing disclosure, or rather that the borrower has to receive the closing disclosure 3 business days prior to consummation. Now, for that business day definition, we're talking about the specific business day definition, which does not include Sundays and the legal holidays that are outlined in the statute. And then we also discussed the other key term in that rule, which is consummation. And consummation is the date on which the borrower becomes legally obligated to the creditor on the loan. And this can vary by state to state. So today we're going to spend some time talking about revisions and corrections to the closing disclosure. Now, Amanda, what are some of the circumstances, or when are some of the times when a creditor would want to redisclose or revise the closing disclosure?
There are 3 different categories of changes that require the creditor to revise the closing disclosure. Those categories are changes that occur before consummation that require a new 3-day business wait period, changes that occur before consummation that do not require a new 3 business day waiting period, or changes that occur after consummation.
Okay, so it is the responsibility of the creditor to make sure that the borrower has an accurate closing disclosure, and that there would be a few different circumstances where you would want to redisclose it, right? So you've got changes that require a new waiting period, changes that do not require a new waiting period, and changes that occur after consummation, right, Amanda?
Correct.
Okay, so I want to take a minute and start to look at what kind of changes would require a new 3-day waiting period. Now, the first of those changes would be if the APR becomes inaccurate. And to determine if the APR is inaccurate, you're going to look at the same rules that we've had in TILA for many years. So for a regular transaction, if the APR is off by 1/8 of 1%, the APR is considered inaccurate. Now, if you have an irregular transaction, then it can be off by up to 1/4 of 1%. Now, the definition of an irregular transaction under TILA has always been one that's been a little bit confusing. So, just briefly, an irregular transaction would include loans that have multiple advances, irregular payment periods, or irregular payment amounts. So it's not just a simple ARM or anything like that. It needs to have one of those specific features in there for it to be considered an irregular transaction. And really what we see out there in the marketplace most of the time, and especially with the investor requirements, is they seem to treat most loans like they are a regular transaction, although most loans are a regular transaction. So the key number to focus on here is the 1/8 of 1% for a regular transaction. If the APR changes by that much, you have to redisclose the closing disclosure, and you have to wait an additional 3 business days after the consumer has received before the loan can be consummated. Now, the next change that would require a waiting period is if the loan product changes. Now, this isn't just a change in a loan product like from a 30-year fixed to a 15-year fixed. We have to look at the technical definition of loan product under the statute. So the rule says that if you have a loan product change that causes the information disclosed under 1026.38A5 Romanet 3 to become inaccurate, that's when you have to redisclose. Now, what is 1026.38A5 Romanet 3? that is the section on the closing disclosure on page 1 at the very top, where you disclose what the loan product is. So if you remember going back to that section of the document, you're going to have descriptors in there like adjustable rate, fixed rate, step rate, and then there are going to be additional descriptors that follow that description, like negative amortization, interest only, step payment, balloon payment, seasonal payment. Essentially what you're looking at here is a change in the way that the payments are being calculated that the borrower is going to pay. So basically the rule here is if you come into a circumstance where you have to change the way that you are disclosing the loan product on page 1 of the CD, that's when you have to redisclose and add an additional 3-day waiting period. Now, of course, the third circumstance is if a prepayment penalty is added to the loan. And that's also disclosed on page 1. So if you say that there wasn't one disclosed, or that there wasn't a prepayment penalty on the loan, and now you're changing it such that you have to change that disclosure on page 1, you have to give a new closing disclosure, and you have to wait an additional 3 days. Now, any other change that takes place before consummation that doesn't fall into one of these 3 categories, that being APR, loan product, or prepayment penalty, you would still redisclose your closing disclosure because you do have to give the borrower an accurate closing disclosure, but you would not have to wait the additional 3 business day period from the time that the consumer received the disclosure. And now Amanda's going to discuss what happens when consumers request the opportunity to review a revised closing disclosure.
The consumer has the right to inspect the closing disclosure during the business day before consummation. If the consumer asks to inspect the closing disclosure, the revised closing disclosure must reflect any adjustments to the cost or terms that are known to the consumer at the time the consumer inspects it. The creditor may arrange for settlement agents to permit consumers to inspect the closing disclosure.
Okay, so one of the changes that Amanda discussed earlier is that you would give a revised closing disclosure in circumstances where the information changes post-consummation of the loan. So the rule is that if a change occurs within the 30-day period after consummation and it changes the amount that is actually paid by the consumer, or the change causes the amount that is actually paid by the seller to change, then you have to provide a revised closing disclosure. Now, the closing disclosure, this new revised closing disclosure, has to be delivered or placed into the mail within 30 days of receiving the notice of change. Now, if it is a change that affects the amount that the consumer is going to pay, the creditor is responsible for redisclosing the closing disclosure post-consummation. However, if it is a change that affects the amount that the seller paid, then it is the settlement agent's responsibility to redisclose the closing disclosure to the seller. Amanda, what are some of the circumstances where you would have to redisclose the closing disclosure post-consummation?
The creditor must also provide a revised closing disclosure to correct non-numerical clerical errors and to refund money to cure tolerance violations. The revised closing disclosure must be provided no later than 60 days after consummation.
Amanda, can you say non-numerical clerical errors 5 times in a row without messing up?
Probably not.
Well, I just thought that would be our new tongue twister for the day out of this TRIDcast. Non-numerical clerical error.
It's a rough one.
I can say that better than I can say she sells seashells by the seashore. Obviously, I don't have a career in radio ahead of me. But yeah, non-numerical clerical error. That's our new phrase out of this TRIDcast today. Well, back to the material that you're interested in here. One of the questions that we often get is about what fees you can charge the consumer up front. And so the basic rule is that the creditor cannot impose a fee on the consumer until the loan estimate has been provided and the consumer indicates an intent to proceed with the transaction. Okay, so there is an exclusion to this rule, though. You can charge the borrower a bona fide and reasonable fee for obtaining the credit report in the application process. However, that is the only one that you can charge. So remember, No application fees, no appraisal fees, no underwriting fees. You can't impose any of these fees on the consumer until you have provided them with a loan estimate and they have indicated their notice of intent to proceed. Which brings up another question. How generally do borrowers give their notice of intent to proceed?
A consumer indicates an intent to proceed with the transaction when they communicate that they wish to proceed after receiving the loan estimate. This can be done by oral communication in person, oral communication over the phone, written communication via email, or by signing a pre-printed form.
Okay, so the rule gives you several different options as to the way that the consumer might indicate their intent to proceed. So I think one of the things that's really important that you need to take a look at here is a policy and procedure. How, as an organization, are you going to give the borrowers the mechanism to determine their intent to proceed? If you have a policy and procedure in place, you can rely on that in determining the best way for borrowers to give this intent to proceed. Otherwise, you might have them giving it to you all many different ways. So that's probably something that you want to look at is what's your policy and procedure and how are you going to do it? Are you going to have a pre-printed form? Are you going to have an email mechanism? There are many different ways, but that's something that you should spend some time as an organization determining how you're going to have the borrowers give this intent to proceed. So back to the prohibited fees question, the basic rule here being that you can't impose a fee upon the consumer until they have received a loan estimate and given their notice of intent to proceed. So that kind of begs the question, what does it mean to impose a fee? Well, under the new rule, a fee is imposed if the person requires the consumer to provide a method of payment, even if the payment is not made at that time. So you've got to be very careful about how you get information or what you require from the borrower up front. So for instance, you could not require the consumer to provide a check for these services, even if you don't cash it until after you receive the loan estimate and the notice of intent to proceed. Or you could not require the borrower to provide a credit card for a processing fee, even if you don't plan on charging it until after receiving the loan estimate and the intent to proceed. So you need to be very careful. You may require the borrower to give you a credit card number for the credit report fee up front, but you would have to ensure that you have a separate authorization for the obtaining of the credit report fee and for the processing of other fees down the road. Make sure that you have only received a method of payment for the credit report fee up front. So that's something to be very careful of and something to consider in your procedures and your policies that you'll be drafting and working on to comply with the rule. So Amanda, we're still getting a lot of questions about the written estimate that is allowed under the rule. So why don't you give us a rundown of what is allowed for written estimates?
The new rule does not prohibit the creditor from providing the consumer with estimated terms and costs prior to receiving the loan estimate. However, if the creditor provides the consumer with a written estimate, it must clearly state at the top of the first page, your actual rate, payment, and cost could be higher. Get an official loan estimate before choosing the loan. The written estimate must be in a font size no smaller than 12-point font and may not have headings, content, or format substantially similar to the loan estimate or closing disclosure.
Okay. Another issue that comes up pre-application is what information can you require the borrower to give you? Now, creditors are allowed to ask the consumer for information, but they can't condition providing the loan estimate on them providing the information. So, for instance, a creditor could ask the consumer the sales price and the address of the property, but they could not require them to provide a purchase and sales agreement. A creditor could ask for the names and account numbers and balances of the consumer's checking and saving accounts, but you could not require them to provide the bank statement. So the rule here is that you can ask the borrower to provide you with information, but you cannot condition providing the loan estimate on them providing you with additional documentation. Now, David, one of the things that we have been asked about here recently is the new settlement statements that have been provided by ALTA, the American Land Title Association. What they have done is they have decided that they have to have a disbursement document that they are going to give at closing, and that this will help them comply with some of the state requirements that they have. And I know at least one state, the state of Texas, is also looking to promulgate their own settlement statement that they will give at closing. And this is right now, as I understand, it is pending final approval by the Department of Insurance at their meeting here at probably, as I recall, the end of June. But the idea here is that there's going to be possibly a different settlement statement that will be given to the borrower at closing. And we've had a lot of questions about this, about whether we're going to be including that in the software. Currently, our understanding is that this is a document that's going to be provided by the title or settlement agent, and that it's going to be generated by them out of their software. So at this time, DocuTech is not planning on providing any of these statements. Also, the only proposed settlement statements that we have right now, they are proposed, and they're model forms that could be changed on a state-by-state or locality basis. So this is something that we're keeping an eye on pretty closely, but we are not currently planning on providing any of these documents in our packages.
Okay. So now, is that something that would possibly take place post-TRID, post-August 1st, or is that something that would be implemented August 1st?
It's something that they would be implementing August 1st. The idea being that right now in some jurisdictions, the HUD-1 gives them when the borrower signs the HUD-1, it gives them the authorization to disperse funds. But they don't have that in the current closing disclosure. So they would just be doing their current process, whatever they're doing right now, whether they are using a settlement statement. I guess some title companies are using a settlement statement even currently right now. So if they're using that, they'll continue doing that, or just continue using the HUD-1 as a disbursement document up until August 1st, and then we might see some more of these revised settlement statements creeping their way into the closing process.
Awesome. Well, a big thanks to both of you for being here today. And real quick, Fred, Amanda, just as an overall takeaway from this TRIDcast, what would you say would be a good last statement for today?
Well, I think one thing is when you're looking at delivering the closing disclosure, when you're looking at delivering a revised closing disclosure, and even with some of the application practices that we've talked about today, you really need to take a look at your policies and procedures so that you have a process in place to deal with all of these issues when they come up. So I would just recommend that everyone really take a close look at the documentation that they have in place so that they can train your staff and your loan originators all the way through the process to make sure that you are complying with all of these rules. So that would be my main takeaway from today, would be to review all of your policies and procedures. Make sure that they are going to work for you in a TRID environment. You also need to recognize that you're going to be dealing with TRID and non-TRID loans for a while, or if you are making the open-end type loans, then you're going to be dealing with TRID and non-TRID loans for the foreseeable future. So make sure that your policies and procedures contemplate all of those different paths that you may have to take to comply with the new regulatory scheme.
Awesome. Well, again, thank you, and we definitely appreciate all the insight that you guys have brought here with these new disclosures. So for all of our viewers, DocuTech would love to answer any of your integrated disclosure questions. So please submit your questions to trid@docutechcorp.com. Our next episode will be on June 2nd at 10 a.m. Mountain Standard Time, where we will be doing a deeper dive into all of the timing requirements with the new rules. To learn about DocuTech, see a previous episode, or to get a copy of today's show sheet, visit our website at www.docutechcorp.com. You can also reach a member of our team at 800-497-3584. And again, thanks for watching.